So I'm excited for like a special video today. We're doing loans 101, right?
Correct. Yep.
So this is great because I don't know very much about loans, and I imagine the same is true for clients of yours, those that are looking for loans, looking to talk to you to figure out if this is going to be a good fit. So they have a lot of questions. So I'm wondering if this video could be helpful for people. It's just like they want to come and learn the basics of loans ahead of time because I'm sure that a lot of them don't know either. Is that true in your
Well,
experience?
it's very true. I mean, and I think anytime any of us get into something that we don't know, we start hesitating. And once we hesitate, we probably miss deals, miss transactions. In the loan business, you're working with a mortgage broker, a banker. What is a loan? What do I owe? There's so many questions that go through so many people's heads because they hear so many things. We just like to, debunk a few things, but just go through exactly what a loan is, what a mortgage is, what a deed is, what to expect when you go to closing, so you get familiar with it. I have the same feeling when it comes to like medicine or some of the other things, or even cars. I don't know a lot about that stuff, so it shuts me down. So I'm going to go get my car fixed because I just don't know what's wrong with it. And I don't want to always trust someone. And if I don't know what's wrong and trying to build that trust to, it just shuts me down. I don't do it, and it's probably not good for my car. Same thing with an investor. If they don't understand the particulars of all the loan side, the leverage side, it's going to slow them down. They're going to make less money, and they're not going to get to where they want to go.
That's super relevant to us. My wife and I just bought a new car, and so we went, and I've went to the mechanic and everything, and I was very put at ease because they explained everything. I was like, I think this is a part of the modern mechanics skill set, is being able to dumb down essentially like these complicated things and explain why this needs to be done, but also to build trust too. So it's like, we're not trying to like pull one over on you here, and that's a challenge. So I think this is a similar thing where it's like, look, we're going to look at the parts of the loan similar to the parts of a car if it needs to be worked on, and explain to you and build trust with your clients out there. So let them know, look, this is how it works. This is the step-by-step what we go through. And we're being upfront with you about how everything is.
And how it works, what to expect, what to look for when you're talking to different lenders. What to expect when you get to closing and things change. What happened? What went wrong here? And from what the lien is and when it pays off and what the lender's rights are and what are your rights. I mean, all of these things are confusing. So we just want to break it down into its simplest forms so people can understand the basics of it and expand it from there. The leverage is king in real estate. You need money to make money. And that goes down to like setting up business cards instead of personal cards. It's different products. Like what's the difference between a bridge loan and a DSCR? But we just want to go through like the basics of a loan so people understand the basics of a loan, closing a loan, and paying it off and what it all means to them and what they could expect from their lenders or should expect.
Awesome.
And what they should know to ask.
Cool. I'm excited. Okay, so let's start with the very basics then. For me,
loans.
I am. I'm a nerd. So let's start with the very basics then. Difference between like a loan, mortgage, and a deed. Would that be a good place to start?
Sure. Yep.
Okay. So yeah, what are those about?
So a loan agreement is just someone borrowing money in the agreement between them. So it's a promissory note. It's anything like that. A credit card is a loan agreement. A car loan is a loan agreement. So the loan agreement is just them borrowing money and coming up with how you pay it back and the terms and everything like that. It's the agreement that comes through, like when you guys negotiate and you go through and the lender puts out their terms and you guys come to an agreement. That's what the loan is. It puts everything in place on your rights, their rights.
Okay, so a loan.
That's the loan or
loan.
the promissory note.
Okay.
Now, the mortgage or deed is a separate instrument. So they were completely different than the loan. What the mortgage or deed does is it secures the loan. It gives the lender security by putting a lien on a property. And what the lien does is it gives the lender rights to that property. The owner has its rights and they come first. But then if anything happens or someone wants to put another loan on it, it gives the rights for that lender. So it says, hey, I just lent this person, let's just say $100,000. A mortgage or deed, which is a separate instrument, goes on record with the county showing that property, there's $100,000, someone borrowed $100,000, and it gives the whole world basically notice that there is a lien on the property. Because if you just had a note, no one would know that it was borrowed on that property, wouldn't give the lender any kind of security.
Gosh, so that's the collateral, if I'm understanding.
That's the collateral, yep.
Okay, so a loan is the official agreement about just two parties, and one is lending money. And nowadays it seems more complicated than that because there are these official entities, like lenders and banks that have evolved to lend money, but it's still just an agreement between two parties. and the loan is that agreement.
Correct.
It's like, what are the terms of this agreement? The mortgage is basically an agreement referring specifically to the collateral for that loan. It's
Yep.
like, if you don't pay this loan, I own the house, or I have a lien on the property. In the case of the bank owns the house until the mortgage is paid.
Yep.
And the mortgage is just that agreement. So it's two agreements that are referring to
The same transaction.
the same transaction. Okay, gotcha. That's helpful. So we're both looking at the money that's being lent. Say it's a $250,000 home,
Correct.
right? There's the 250 right here. I'm picturing it. And then there's a mortgage agreement and a loan agreement that are referring to that amount.
Correct.
Okay.
Correct. And it's no different than a car. You take out a car loan, they put a lien against your title of your car.
Mhm.
Now, the other end of that is credit cards, where you could take out a loan and there is no collateral. But the difference there, too, is you can see what unsecured, that means there's no collateral, and
Mhm.
secured. Someone sent me over their agreement, or the rates had just changed on their credit card. It was a department store card, but the rate just went up to 33%.
Mm.
So the difference between unsecured and secured is typically when you secure something, you'll get a better rate.
Mm.
So because unsecured, anything could happen, the lender is, the only thing they have is that paper and your promise to pay.
Mhm.
Real estate and real estate investing, we put a mortgage or a deed, and I'll go through the difference between those two,
Mhm.
on a property to protect us, give us more security, which also gives you better rates. So there's always,
Yeah.
Like,
It's
it
better
helps
rates
the
and it's
lender.
more money, right?
Yeah.
Because it's very hard to get a credit card for $250,000.
Yep.
Yeah.
so it gives you the ability to borrow more and gives the lender the security they need to lend you more. So
Gotcha.
if you look at it, it's there to protect both of you.
Mm-hmm.
Now, mortgage and deeds are basically the same instrument, just in different states. So a deed of trust is an instrument that was established because of a lot of the banks back in the day would give a farmer a mortgage, and then they controlled the property. So a banker would go lend some money, they would keep the mortgage, and everyone would know about it, and then they could just foreclose when they wanted to. So that's where the deeds of trust came in, which means there's a trustee.
Right.
There's a third party who holds the instrument, meaning they protect both parties. So it's a lien where there's a third party involved. And the biggest difference between now, the mortgages, which are just different states. Different states require different instruments. They provide the same security for both,
Mm-hmm.
but it's just state by state on which they do it.
Okay, so if I'm understanding, due to historical reasons, some states have deeds and some states have mortgages.
Sell mortgages, yep.
So you never have both at the same time? Or like in most
No,
cases?
it's either going to be a mortgage or a deed.
Okay.
Yeah, there are some states that will accept either of them. But the only difference is a deed of trust. They put the instrument with, like in Colorado, it's a public trustee. So if anything happens, like a foreclosure, they actually have to go through a public foreclosure sale, and they make sure it's done properly.
Mm-hmm.
In other states where it's a mortgage state, it's more of a judicial process where if something happens, you have to foreclose as a lender, things come up, it has to go through the judicial system, which means lawyers, lawsuits, and everything else. Where a public trustee, they just hold a sale based on what's in the document. There's attorneys involved, but it's not a court procedure. It's just an administration procedure. But you may hear mortgage, you may hear deed. All you have to really know is just the instrument depending on your state, but it does the same thing.
Okay, so they do the same thing.
Yeah, gives you the security as a lender and puts the lien on the property.
Okay, they do the same thing when it comes down to like what might happen in case of a foreclosure. The processes are different. The way that the government is handling things is different. But for our intents and purposes, for your average real estate investor, mortgages and deeds are practically the same. It's just they're going to vary a bit depending on state, which one they're going to
Correct. Yep.
lean towards doing.
Yep. Just because of their history, their laws and everything. And we shouldn't worry about that because we're not going to go through that process. We're going to get our flips done, we're going to get our rentals done,
Uh-huh.
and we're going to move on. So that's the basics of a loan. It's just a loan document
Uh-huh.
and a lien. Yes, now there's some other paperwork that goes on. They might ask for some rent agreements and insurance agreements. There's other paperwork when you close a loan, but the two main things are your loan and your lien.
And there are two types of liens,
Yep.
mortgages and deeds.
Correct.
That's all. Okay,
Yep.
so loan and lien, L and L, and it's either a mortgage or a deed for the lien.
Correct.
Interesting. Okay.
Yep.
So I think another big question that I would have is, how does interest work? I imagine you get that a lot too,
Yep.
right? Like I don't really know how it sometimes seems straightforward, but with housing and real estate, it seems different. Is that true?
It is. And interest works in the mortgage industry a little bit different. And I think the confusing part is when is interest paid when you make a payment. If you're closing on a loan, let's just say we're closing today. At that closing, the lender will ask for a certain amount of interest. So let's just say, for instance, we're closing something on May 24th. And on May 24th until the first of the month, that's 7 days. So they'll collect 7 days, and then they'll say your first payment is not due now till July 1st. Because what they've done is they've collected interest from May 24th through May 31st. Interest on mortgages is always collected what they call it in arrears. Mm-hmm. So when I make my July 1st payment, it's really interest through all of June. Mm-hmm. Lending companies, on even if it's amortized or interest only, collect the interest after it's due. So if I make July 1st payment, unlike rent, which is paying for that whole month's rent, and I'm covered for that month, when you make the July 1st payment, you actually paid all of June's.
You paid all of June's interest, but you're paying so it's like the payment for the property is going forward, but the interest is being paid from the previous month.
Yep.
Okay, so arrears means in the rear.
In the rear. So
gotcha. Behind us. That's and it's interest again. Interest is behind, but the payment is what's being paid ahead. That is a bit confusing, but now that you're saying it, I'm like, okay, I got it.
Yeah. So just to be clear, you make a payment, and if it's interest only, like all bridge loans, a lot of fix and flip, all those, all they do is collect the interest. They're not paying down on a loan, which is called amortization.
Okay.
On the interest only, when I make my July 1st payment, all I've done is paid June's interest. I haven't paid anything down. The balance is still the same because it's interest only. I'm not paying anything else like that. If you get into like the DSCRs and the 30-year Fannie Freddies, on that July 1st, you're going to pay all the interest for June and pay a little bit down on principal. Mm-hmm. And your balance is going to go down slow and slower, and it's going to start picking up speed. In the real estate business, a lot of short-term loans are done. It's all interest only. And like I tell people, it's like when you close your loan, you didn't at closing give them a check for the next month's interest. Mm-hmm. They gave you a little grace period to get things going. And then once that month is over, then you pay the interest. And that comes up again when you do a payoff.
So you can't give them a check to pay for the next month's interest?
You could, but you're just prepaying. You could at any time, just like any credit card or anything, you could pay them in advance.
Could prepay, yeah.
Most people are not going to do that.
Yeah.
Most people, it's a cash flow game, keeping everything in line, keeping as much cash in your company, in your business, and less going out, so you have options. And cash is king in real estate, and you got to keep your cash flowing, as we say here. So that's important to understand how the mortgage is set up. Even like we go back a step, when you're talking to a lender and you're going through closing, especially the first time, you have to understand when you go to closing, they're going to give you, your settlement statement. It's going to say, here's all the charges that I'm going to get charged for the real estate, for the title, and for the lending, and all that stuff. So maybe you have a down payment, but you're also going to have all those expenses. Mm-hmm. And you have to understand that when you go into a closing, that you have to anticipate putting 20% down. Okay, I did a $100,000 loan. I need to bring in $20,000. Well, no, you're going to have to bring in more than $20,000, typically, because you have to pay for all the services to close that transaction. Might be title, might be the loan, all those things. So these are the things that come up the most. People get surprised when they go into closing. They're like, I wasn't expecting this. Mm-hmm. So number one, make sure you get those numbers up front, calculate them, have the mortgage person go through them, make sure you understand everything you're getting into 2 or 3 days before you go there, because way too many people just go to closing and get surprised.
Do you have resources on your website or anything where you can see like what are the standard closing costs, or are there other videos that walk through that in more detail?
We don't, but we definitely can put something out there. Our whole goal when we do a loan is to make sure, number one, that people are absolutely clear what they're going to see, do, their rate, get it in writing. Make sure even when you're reaching out to lending companies that they're not doing a hard pull on your credit. Simple things to make it easier for investors is what we're focused on, because we're not trying to put something over or make double or triple what you could on a loan. Our goal is to create relationships, work the human-to-human aspect that we can help them get bigger and grow, and the same with us. Is if we both win, it's a lot better transaction.
Yeah. Surprisingly, I'm understanding all of this so far, which is great. How does it work when they pay you, the lender, off when the lien process is ending?
So let's just look at a fix and flip for the payoff, because it's probably the easiest thing, because it's usually a short-term loan, 6 to 9 months. Works the same for DSCR and anything like that. So we closed the loan, we put a lien on the property, they fixed it up, they sold it, now they're at closing, selling it to their buyer. When they're at closing, there's always a title company, there's always an attorney, someone who is a third party, making sure both sides get what they want. That third party reaches out to us as a lender, whoever the lender is. Number one, requests a payoff. They get all the numbers, everything that's owed, which is typically principal and a little bit of interest that is owed. And then that third party, what they're responsible for too, is to pay off the lender and to make sure the lien is released. So they take care of making sure that mortgage or deed is basically taken off, wiped off their property. So you as a flipper or you just refinancing out can now transfer ownership to your new buyer. So the lien and the lien release are all taken care of by the third party, making sure everything is done because they don't want to rely just on us as a lender to make sure it gets done. Because once we get paid off, maybe we take a week or two, but the third party is always going to make sure it's done and done on a timely
Okay.
manner.
What is this third party called? Who typically is it?
It's usually a title company, escrow company, or an attorney. On the other hand, we have these people who walk in and go like, here's a check, I'm paying off my loan. They don't go through a title company, everything. That's probably 1 or 2%. Those people, when they pay it off, they need to get a receipt. They need to get a lien release form. They need to get their original documents. They need to make sure it gets recorded themselves. But 99% or 99.9% of all transactions are completed by a third party. That third party is completely responsible to make sure that lien, and like a title company, they give the new buyer, the one you just sold the property to, they give them insurance of saying that you're buying this free and clear. So if they don't release our lien, they're responsible for that. That's why there's typically always a third party involved, because they want to make sure that transaction is complete and that the new person gets a free and clear property.
Okay, so they're mostly worried if we have these two. We have the loan and the lien. The lien, let's say in this case, is a mortgage. Sometimes it can be a deed. So they're more concerned with that lien, with the mortgage.
Yep.
And they're making sure that everything is tied up right there. And that's to be helpful for both of you, but especially for the client, for the individual, for the investor.
Yep.
Okay.
So the investor does not have to worry that, something is going to come up later. If you pay it off in full, you'll get a full release and show that the note is paid in full.
Okay.
So they'll take care of all of those, and that's why you pay a title company or attorney to handle these things. So you're free of the loan requirements and the lien, because there are situations where a property sells and it is not enough to pay off the whole loan amount. So you got to make sure everything is done, because that means that you are still responsible for that amount that is out there, because the lender might release the property but not release the loan that you're due. But that's a different rabbit hole, probably shouldn't go down. But you just have to
Not a very common situation.
Yeah, not a very common situation.
Right. But it's helpful to understand that that's what they're there for, is like they can mitigate that situation if it arises. Really, the main thing is just to make sure that everything is worked out with these two agreements.
Yep.
The lien and the loan, or the mortgage and the loan in this example. They're there to make sure that you're actually free and clear.
Yep.
Because you're not an expert in that, right? Like
Exactly.
Neither of you are. And so this is to make sure that the investor everything is all tied up and perfect, and they're an expert in that. You're an expert in the loan service providing.
Correct.
Okay, gotcha.
Yep. We want to make sure the investor understands the process so they can feel more comfortable going all the way through. So when they get done with that closing, when they sell it, they don't have to worry about, do I still owe anything, or where's the lien? Or here's just one other quick example. Sometimes people will do what they call a cross-lien, meaning they'll use a loan, but they have to lien two properties because there's maybe not enough equity. So you can have a loan with two mortgages or two deeds on different properties to give enough security, collateral to the lender to have them give you the money you need. So once again, the same thing is a lot of investors are like, how am I going to get this property back? They want to know the process. And the process is the same thing. Let's just say they go into title, they sell this property, and it's enough to pay off the whole loan. Title will release both liens. So then they have freedom. They understand exactly what's happening, and that they can now not worry about a lender. Like a lot of people just worry that lenders are going to come after them. And the truth is, it barely ever happens. And the only reason they do is because someone didn't keep up their end of the bargain. Like they're not paying them. There's situations where lenders have to go through a process and they don't want to. They just want to lend their money, get their money back and some interest. If everything works out, that's all they're looking for. These instruments just help them lend and be secure to keep lending more and more money too.
Okay. So would you say if you're talking to a client, that's the justification for working with a title company and having these different closing costs is like, look, this is going to save you. I know it can be frustrating. You didn't know it was going to be this much. We'll try to tell you ahead of time. But if you don't do this, then there's the possibility that you just miss something and then you're not fully paid off. And so then there's this whole thing where like potentially a lender is like, I need to get my money back. I don't want to do this, but I have to. And so the title, having that arbitrator, having a title company there helps to keep that from happening.
The title company helps so much. And there are a lot of people who are like, that's just a waste of cost or whatever. It's not a waste of cost. It's just like in car insurance. It's there when you need it. Title insurance is the same way. They're just ensuring that once you leave there, they're going to take care of everything else or insure over it. Like if they messed up and missed a lien or didn't release yours, it's their responsibility, not yours. I think it's a very, very important instrument in the real estate world is title insurance.
Yeah, 100%. Like most kinds of insurance, I think, to me, seem like a win-win. It's like, peace of mind, but then also the insurer is making money because the odds are you give insurance to enough people that like not all of them will need something. So you can make money as an insurer, but then, whether it's, like health insurance, not everybody's going to have a medical emergency, but for those that do, then the insurer has this big amount of money to help with that, if something does happen. So it's like paying for peace of mind to an entity that makes it to where you don't have to pay a ton for that is, I think, a good product.
Yeah, you lose on one of these deals and it's $100 or $500 I mean, it's like a big number.
Yeah.
So paying $1,500 here and there at a closing.
So it seems like we went through most of the process here. We learned what the differences between mortgage and a deed are. Those are both two types of liens. We learned about how interest works. You pay that off in arrears, but you pay the payment going forward. And then we also learned how a closing works and why you want a title company, why that cost is there, why it's definitely worth it.
Yep.
Okay.
Yep. So that's a basic loan in the heart of the docs you use. I know there's going to be another 50 or 60 docs on making sure you have consent and everything else. But when it gets down to those are the basics, which is the loan, the mortgage, the deed that's on this property. And it's the same if it's a short-term loan, long-term loan, like a DSCR, conventional. Those are the basic instruments that you come to is like, I promise to pay. They're putting a lien on the property. How is it taken care of when I'm all done or paid them off or paid them down? I mean, there's some loans that you pay over 30 years and they're gone. And it's the same, like that has to be released too. So,
yeah. So it sounds like these core documents are basically just agreements, They're agreements and they're a bit complicated, so it's a good thing that we write them down and we have different versions and then there's a third party to make sure that the agreements are being met well so that the negative side effects, which are agreed upon ahead of time, like this will happen if you don't pay, those are in the documents. The title company's there to be like, you really don't want that to happen, so we'll help you. So it's just people agreeing and somebody, arbitrating those agreements.
Yep.
That's the whole process.
In a nutshell, that is the loan, the agreements, the payoff, the interest, the basics of those things. And that's what we want to just kind of go through is some of these basics so you understand them, so you feel more comfortable, so you do more deals, so you make more money.
Awesome. It's been great, Mike. Thanks for chatting today.
You.